Hello and welcome to our discussion on the ProShares UltraPro QQQ ETF, TQQQ. This ETF is a unique investment option that offers a high level of leverage and is designed to provide investors with the opportunity to potentially earn significant returns. In this script, we will delve into the details of the ProShares UltraPro QQQ ETF, including its investment strategy, risks, and potential benefits. First, let's talk about what the ProShares UltraPro QQQ ETF is and how it works. The QQQ stands for the Nasdaq 100 Index, which is a market capitalization-weighted index of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. The ProShares UltraPro QQQ ETF is an ETF that tracks the performance of the Nasdaq 100 Index and aims to provide 3 times the daily return of the index. The expense ratio or management fee of the ETF is 0.86%. Now, you may be wondering how the ProShares UltraPro QQQ ETF is able to offer such a high level of leverage. The answer lies in the use of financial instruments called derivatives. Derivatives are financial contracts that derive their value from an underlying asset, such as a stock, bond, or index. In the case of the ProShares UltraPro QQQ ETF, the underlying asset is the Nasdaq 100 Index. The ProShares UltraPro QQQ ETF uses derivatives to amplify the daily returns of the Nasdaq 100 Index. These derivatives are essentially bets on the direction of the index and can increase or decrease in value based on the performance of the index. By using derivatives, the ProShares UltraPro QQQ ETF is able to offer investors the potential for significant returns, but it also carries a high level of risk. So, what are the risks associated with TQQQ? One of the main risks is that the ETF is highly sensitive to changes in the value of the Nasdaq 100 Index. If the index declines in value, the ProShares UltraPro QQQ ETF will also decline, potentially leading to significant losses for investors. Additionally, the use of derivatives introduces counterparty risk, which is the risk that the party on the other side of the derivative contract will default on their obligations. This risk is mitigated by the use of high-quality derivatives, but it is still a potential concern for investors. Now, let's talk about the potential benefits of investing in TQQQ. The main benefit is the potential for significant returns. As mentioned earlier, the ETF aims to provide 3 times the daily return of the Nasdaq 100 Index, which can lead to significant profits in a relatively short period of time. Additionally, the ProShares UltraPro QQQ ETF is a liquid investment option, meaning it can be easily bought and sold on the market. This makes it a convenient choice for investors who may need to access their funds quickly. So, who might be a good fit for the ProShares UltraPro QQQ ETF? This ETF is best suited for investors with a high tolerance for risk and a long-term investment horizon. Due to the high level of leverage and potential for significant losses, this ETF is not suitable for risk-averse investors or those with a short-term investment horizon. It is also important to note that TQQQ is not a diversified investment, meaning it is heavily concentrated in the Nasdaq 100 Index. As such, it is important for investors to carefully consider their overall investment portfolio and ensure that the ProShares UltraPro QQQ ETF is a suitable addition. In conclusion, the ProShares UltraPro QQQ ETF is a unique investment option that offers the potential for high returns and easy access to a diversified portfolio of technology, healthcare, and consumer-focused companies. While it is more volatile than a traditional ETF, it can provide investors with an opportunity to participate in the growth of some of the most innovative and successful companies in the world.